Ladies and gentlemen, welcome to the silent economy. If you want to understand whether China is preparing for a real, kinetic conflict, stop watching the Taiwan Strait. Stop counting fighter jets. Stop analyzing satellite photos of military bases. That's all theater, designed to be seen, to signal, and to distract. The real preparation is happening in places you're not looking, in customs databases, in commodity futures positions, in the quiet rerouting of cargo ships that used to dock in Rotterdam but now end their journey in Shanghai. Just a couple of days ago, Beijing executed a coordinated policy shift that the Western financial media is barely noticing, calling it a simple trade adjustment. They are missing the signal. What China just announced is not trade policy. It is economic mobilization. They've tightened export restrictions on critical minerals. They've mandated domestic priority for silver, copper, and rare earth processing. They've ordered state-owned enterprises to accelerate strategic reserve accumulation. In plain English, China is starting to cut off the West from the raw materials required to fight a modern war. This isn't just preparation for conflict. This is the first salvo. The war has already begun. It's just not being fought with missiles yet. In this briefing, I'll show you the 3 key policy documents Beijing released this week, explain why silver is the canary in the coal mine, and reveal what this supply shock means for the price of metal sitting in Western vaults. The data is clear, and the pattern is unmistakable. By the end, you'll understand exactly how to position yourself before the next escalation. To grasp the magnitude of what's happening, we need to look at 3 documents that Western analysts are not reading carefully enough. First, the Ministry of Commerce issued updated export controls on critical minerals. Buried in the bureaucratic language is this phrase, strategic reserve prioritization shall supersede commercial export obligations. Translation, if China needs it, you don't get it, regardless of contracts. And silver is on that list. This means Chinese refineries, which process 85% of the world's silver, can now legally redirect it from export markets straight to their own stockpiles. Second, the State-Owned Assets Supervision and Administration Commission, or SASAC, issued a directive for all state-owned enterprises to accelerate acquisition of strategic materials. This isn't market buying, it's a command. When the Chinese state tells its companies to acquire 1 million tons of copper, they do it. Price becomes secondary, and availability for the rest of us drops to 0. Third, the People's Bank of China received expanded authority to intervene in currency markets, specifically to facilitate these purchases. They can print yuan, convert it to dollars, and sweep global commodity markets before anyone else can react. They've built the legal framework, authorized the funding, and designated the targets. And silver is target number 1. Why silver? Because the numbers tell a terrifying story. Global silver mine production is about 820 million ounces a year. But global demand is 1.2 to 1 billion ounces. That's an annual deficit of 390 million ounces, and this is the 5th year in a row. Now, add China's own consumption. Just for solar panels, EVs, and electronics, they need about 270 million ounces. That's a third of the entire global mine supply, and their demand is accelerating. The math is broken. There's not enough silver on Earth to satisfy China's industrial appetite while also supplying the rest of the world. So, they made a choice. They're taking it all. Thanks for watching. Be sure to subscribe for our next briefing. When Western economists see China's export controls, they scream protectionism. They run their models, they debate WTO violations. They're thinking like academics. But Beijing isn't thinking like academics. They're thinking like generals. Let me explain the military logic driving this economic war. China has one single existential vulnerability, the Strait of Malacca. This narrow 550-mile choke point handles 80% of China's oil imports and 40% of its total trade. In any conflict, the U.S. Navy's first move is simple and predictable. Close the strait. Strangle the Chinese economy without firing a single shot on the mainland. Within 6 months, China runs out of oil, factories shut down, the military machine grinds to a halt, its defeat by strangulation. Beijing has studied this scenario for 30 years, and their counter-strategy is now fully operational. Phase 1 was electrification. Replace foreign oil with domestic energy, solar, wind, nuclear. In fact, China installed more solar capacity last year than the United States has in its entire history. By 2030, they aim for enough solar power to run their entire industrial base without a drop of imported oil. But there's a catch. Solar panels require massive amounts of silver. There is no substitute. The physics of photovoltaics demands it. No silver means no solar means no energy independence, and no energy independence means no chance of surviving a conflict. This brings us to phase 2, supply chain capture. China doesn't just use silver, they process it. 85% of the world's raw silver ore is refined in China. The ore comes from places like Mexico and Peru, but it all gets processed in China. This gives Beijing a choke point of their own. and their new export controls just weaponized it. They've essentially created a one-way valve. Raw materials can flow in, but the finished refined silver does not flow out. And that leads to phase 3, strategic stockpiling. For the last 18 months, Chinese state-owned enterprises have been on a buying spree, accumulating every physical commodity they can get: copper, grain, oil, and of course, silver. The amount of physical silver being pulled from the Shanghai Exchange for industrial use, or stockpiling, is staggering. We're talking about an annualized rate of 135 million ounces. This isn't just business as usual. When you see a nation simultaneously restrict exports, accelerate imports, and stockpile the finished product, you're not watching trade policy. You're watching mobilization. The economic war has begun, and silver is the first battleground. Now, let's look at what this means for the rest of us. Focus on 3 numbers. First, the COMEX registered inventory. The COMEX is the main U.S. futures market for silver. It's where you go to get physical delivery. In 2021, COMEX held 150 million ounces of deliverable silver. Today, it's just 38 million ounces, a 75% collapse. But it gets worse. There are paper claims for 700 million ounces of silver, with only 38 million ounces available to back them up. That's a ratio of 18 paper claims for every 1 physical ounce. It's a game of musical chairs where most players will be left standing. Second, the London vaults, the LBMA. This is where central banks and big institutions store their metal. Since 2021, over 450 million ounces of silver have vanished from London vaults. Where did it go? Shipping data shows a consistent flow east, from London to Dubai to Shanghai. Once that metal enters the Chinese system, their export controls mean it never leaves. Every ounce that goes east is an ounce permanently removed from Western markets. Third, and most importantly, mine production. Most silver isn't from dedicated silver mines. It's a byproduct of mining for other metals like copper and zinc. The world's largest primary silver mines are depleting. Their output has been falling for years. And the copper miners? They aren't expanding. It takes a decade or more to bring a new mine online. There is no cavalry coming to boost supply. Meanwhile, demand is exploding. The solar industry is projected to triple by 2030. Electric vehicles use 50% more silver than regular cars. Even AI data centers need silver for their advanced components. We are witnessing a historic supply and demand collision. And China just hit the accelerator by effectively nationalizing a huge portion of the world's refined silver. This isn't just about markets anymore. It's about strategy, and the game has completely changed. Thanks for watching. If you found this analysis valuable, make sure to like, subscribe, and hit that notification bell for more deep dives into the forces shaping our world. See you next time. Let's talk about what happens when the pressure on COMEX silver reaches its breaking point. You see, the entire COMEX system runs on trust. Traders buy and sell silver contracts, and while they could theoretically ask for the physical metal, 99% of them never do. They just settle in cash, roll their contracts to the next month, and keep trading the paper. The system only works as long as there's enough physical silver in the vaults to maintain the illusion of delivery. But right now, that belief is being tested. With registered silver inventories at just 38 million ounces and still dropping, we're approaching a critical moment. Imagine this scenario. It's what keeps exchange officials up at night. A large entity, like a sovereign wealth fund or a major industrial user, decides they want their metal. They don't want to roll their contract. They don't want to settle for cash. They stand for delivery. And let's say they want 50 million ounces, which isn't an unreasonable amount for a stockpile, but the vault only holds 38 million ounces. COMEX can't deliver. At this point, they have 3 terrible options. Option 1 is a straight-up default. They admit the warehouse is empty and fail to deliver. This would be catastrophic, leading to lawsuits, investigations, and a total collapse of confidence. The paper price would become meaningless, and the real price of silver would be whatever someone holding the physical metal decides to charge. Option 2 is to change the rules mid-game. They've done it before, back in 1980, during the Hunt brothers' attempted corner of the market. They could suddenly ban new purchases, hike margin requirements to impossible levels, or just declare that all contracts must be settled in cash, no exceptions. This would save the exchange itself, but it would be an open admission that the paper contracts aren't backed by real silver. Imagine the panic when holders of silver ETFs like SLV realize their shares are claims on nothing. Option 3, and perhaps the most likely initial response, is a massive price explosion. To avoid a default, COMEX would have to pay any price necessary to find physical silver, sourcing it from London, Singapore, or private holders. The spot price could jump $5, $10, even $15 an ounce overnight just to attract sellers. We're already seeing a version of this in slow motion. The gap between the paper price and what you pay a dealer for a physical coin or bar is already $3 to $5. When big industrial players start paying those kinds of premiums, that spread could easily widen to $10 or $15. Then, the global market takes over. Why would anyone sell their silver to COMEX for $35 when buyers in Shanghai are paying $40? The metal will simply flow east, draining the Western vaults even faster. One day, that inventory number will hit 0, and we are much, much closer to that day than most people are willing to admit. Thanks for watching. How do you protect yourself when supply chains start to crumble in an economic war? You follow a simple protocol. Rule 1. Acquire physical metal now. Not tomorrow, not next month. The window to get it is closing fast. Look at China. Their citizens can no longer buy silver through their banks. Soon, when Western industries start panic buying, retail supplies will vanish. Right now, premiums of $3 to $5 over spot price for coins and bars are still reasonable. But when the real squeeze happens, expect those premiums to jump over $20. Stick to recognizable forms like American Eagles and Canadian Maples, or 10 and 100-ounce bars from trusted mints. You want pure silver that any dealer will instantly recognize and buy. Rule 2, stay away from paper silver. ETFs like SLV are just claims. They're not the real thing. Read their documents. They can pay you in cash if they can't get the physical metal. Futures contracts can be a trap too. Exchanges can change the rules and force you out. And mining stocks, they're exposed to all sorts of risks, from government takeovers to operational failures. The golden rule is simple. If you can't hold it in your hand, you don't really own it. You just own a promise. Promises can be broken. Rule 3, keep an eye on the Shanghai premium. This is your early warning signal. Right now, it's about 10 to 12% above Western prices. That's high, but stable. If that spread hits 15%, it means the COMEX exchange is having trouble delivering. If it hits 20%, there's a serious physical shortage. And if it ever reaches 30%, the paper market is likely breaking down completely. Rule 4 is to watch for exchange interventions. When you see headlines about emergency margin increases or new position limits on the COMEX, the game is almost over. Your chance to buy will be gone. Think like a major global power. China isn't buying silver to make a quick profit. They're stockpiling it to survive a conflict. They're converting their paper assets, like US Treasury bonds, into hard physical resources that can't be sanctioned or devalued. You should be thinking the same way. This isn't just speculation, it's about positioning yourself for a massive shift in the system. The bottom line is, the economic war has already begun. China's strategy is public, their actions are clear, and the data shows their accumulation. Silver is at the heart of this because it's irreplaceable. You need it for solar panels, electric vehicles, and advanced military tech. Beijing knows that controlling silver means controlling the future of energy, transportation, and defense. While the West is busy debating, China is quietly emptying the world's vaults. The supply freefall isn't a future event. It's happening right now. The only question is whether you'll see it before it's too late. Thanks for watching.